Hey everybody, Chris Epp here, and welcome to our latest vlog in the series Charting the Way Forward in Student Housing. Today we're going to talk about debt and equity and the availability of it in today's market. And who better to discuss that than FourPoint's very own Craig Miller. Craig, thank you very much for being on the call today with me.
Thanks, Chris. Glad to be here.
So Craig, let's jump right into it. No question, debt and equity was in abundance prior to COVID-19 washing up on the shores here in the United States. Then boom, things have kind of been in chaos ever since. Walk us through the last 8 weeks from a debt perspective in the student housing space.
So what we do know is that the government-sponsored entities, right, Freddie Mac, Fannie Mae, the largest providers of debt financing in the student space, were shell-shocked like the rest of us. You know, they've adjusted their terms. They are really quoting the new deals for select borrowers. They've increased spreads. They've put index floors in place, and they've also required holdbacks and interest reserves.
So Craig, that sounds pretty onerous, and I guess I can understand why that would be the case. Let's just focus in on Freddie and Fannie. They've always been pretty transparent about their goals in the amount and terms of the money that they plan on lending in any given year. What are you hearing from your sources at the GSCs right now about the next wave of capital into the student housing space?
Most of the focus will be on sponsor and market, right? And a return to normal is going to require two things: universities' announcement that they are back in business and kids will be in class in the fall, and then number two, that 2 months of rental receipts. That October rent roll comes in, and they'll be ready to rate lock and lend.
Let's shift over to the equity side of things. Are the phones ringing? Are you getting the inbound calls that you once received in the student housing equity world?
At the beginning, things were a little quiet, right? We were all trying to figure out the state of the world, but the bomb went off, and shortly thereafter, the phones did too, right? We had foreign and domestic capital providers calling us, asking our thoughts on what to do next, right? And so, call it a suspended animation, if you will. People were saying things but not really doing anything, and it was all about developing a strategy until we got that green light. So Chris, imagine a pie chart, right? The first group of investors, they're going to be all cash buyers. They don't need any kind of debt solution to transact, and they are ready and willing to take down an opportunity, albeit at a discount. And they're about 10% of the pie. The next group, their thesis hasn't changed, and that's no change in strategy with asset type, market, any type of return profile. And so this group is really only underwriting the pandemic risk. They're ready to go, but they make up about 40% of this pie. The last group is the most prevalent student housing buyer that we've seen in the past, about 50% of the pie. They've got a fund raised. They have a fund mandate, and once school is back, they plan to spend that money as originally intended.
Let's talk about the future, and I would like to break it up into 3 distinct timeframes. Now, and what happens just in the immediate term, the near term, which would be when the fall semester starts, and then let's fast forward 2 years out. Talk to us about transactions, both from a debt and equity perspective in the student housing space along that timeline.
In the short term, the most prevalent opportunities are going to be recapitalizations or loan maturities or refis. And so, and we also think that any transaction today is most likely going to be an off-market deal. Fast forward to the midterm, right? October 2020. Schools are back in session. Kids have moved in. A huge part of this equation is really been solved for. And so what we're seeing then is, 2 buckets of buyers as the transactions pick back up. Number one is the deals that lease up. In bucket number 1, kids are at the properties, agencies are lending again, and we're going to see probably about 90% of the transactions in this bucket. The other bucket is on the flip side, right? Deals that did not get leased up. The PPP funds are dried up. The CARES Act is in the rearview mirror. this group of sellers is going to need liquidity. And so this is where, and I think the 10% will come in and have a shot at really finding deals. And then lastly, the long term, right? Moving forward 2 years, October 2022. The vaccine is in place, but we've got a macro recession. So, what we see then is an increase in student enrollment across the U.S., similar to what we saw back in 2008. And we've also seen a decrease in supply for U.S. student housing. We've all seen that in the past, student housing is a recession-resistant asset class, and we believe student housing will show its true colors, return back to normalcy, and really debt and equity are going to flock back to this space as a safe haven for capital deployment.
Craig Miller, thank you very much for your insight. Very much appreciated. Thank you, everybody, for joining us today on our vlog. Next week, my long-term partner, Chris Bancroft, joins us to talk about the long-term prospects of student housing investment sales. Thank you very much for making the call today. We look forward to your feedback.